Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Welcome back to the show, Danielle.
Thanks, Jim.
Danielle, how would you describe what's happening on the stock markets right now?
We've been in I would say, a type of blow-off speculative episode since the end of the first quarter, let's say around May 23rd, when things turned around from the record drop from February to March. And we saw a huge surge of rebalancing of both. There's two main things that were leading it. It was the rebalancing of the passive allocators, so that have to have a fixed percentage of stocks and bonds. So with stocks having fallen 37 or 40% or so in a matter of the last month of the quarter, you saw a lot of people having to buy stocks and sell bonds, so that was part of the function. Then you also had a bunch of short covering, so people that had gone into the downturn expecting it and being short of stocks, once they got such an incredible, quick drop, they bought back a bunch of shares to cover some of that short. So that was the other major sort of factor that was behind the bounce in the last 3 months. And the final aspect that came in, of course, was this cohort of the retail speculator. So this is really something that's quite unique and typical of the very final stages of a asset bubble, which is when the retail trader, person that has zero experience, memory, or expertise in what they're doing, wouldn't know how to read a balance sheet or know anything about valuations, decides that all they have to do is trade it, and that it's a game, or it's like a video game, or it's, something that they can quit day jobs and stay home and make themselves rich trading. That's sort of the type of mass mania that sweeps. Now, right now, of course, with the layoffs, the furloughed people and the shutdown in the employment market, with the COVID pandemic, we have a bunch of people that are held up in their homes, with not much to do, rich in time, as I say, and they are basically trying to, make themselves money by blindly trading this stuff. So when they have early success, because things have been rising, they tend to get overconfident very quickly. You've got a lot of gurus who know nothing about it, who have started YouTube channels, and they're really showing people, how to make themselves quote unquote rich. So that's been this other layer of mania that's gone on, and there's been studies done to show that the amount of new accounts that have opened in these online trading platforms, whether it be the Fidelities, the Schwabs, the E-Trades, the Robinhoods, which has a median age of a customer of about 30 years old, all these new account openings, many of them have seen a surge of 30% or so just in the last 3 months in their new account openings, and that is correlated positively with the stocks that they're buying. The ones that they're wailing away on have really seen increased momentum, and that includes on the up and down days. So there's definitely a relationship there. The other thing is, people say, well, don't retail people have little money? How can they possibly move these markets? The fact is that they're mimicked or followed. Their momentum is magnified by a couple of things. One is the fact that they're using margin debt, which is one of the ways that these trading platforms make profit. So they use the loss leader. They advertise to the retail person that, that there's no trading costs, so they can execute these things for quote unquote free. Well, what happens, of course, is that the money has to be made somewhere. So where the money is made is to get that, the customer that's not paying is actually the product. The product comes in, and the broker makes money by giving them credit to gamble with, which tends to be highly profitable for the broker. The other thing is they are using other kinds of leverage like options to magnify their exposure, which again, when things are going up, that looks genius, and when things go down, that tends to devastate you. And the third way that they're making revenue in this environment for the platforms is to sell the order flow. So this is something that's been going on for the last decade. It was actually originated by Bernie Madoff, believe it or not, the man who made the massive Ponzi scheme that went bust ultimately in 2009-10. But basically, he originated this idea of selling their customer order flow to dealers, and the dealers, the market makers, they front run it. So they get the orders, they execute them, but before they execute them, they have advance notice of what the orders are, and so they can trade in front of that. And it should be illegal as market manipulation. It certainly would fall under that category, but what they've done is they've secured a compliant regulator over the past decade by offering these revolving door appointments to the people who are heading up these market maker firms, in and out of government regulators. I mean, the most famous being Ben Bernanke himself, who, when he left the FOMC in 2015, went to Citadel, which is one of the biggest market maker firms, and they've been doing this cozy little relationship, which has made them all millions and millions of dollars. Just one example, Robinhood, this startup platform that many of the 30-somethings have been trading on in the last couple of years, they received nearly $50 million from just Citadel alone in the first quarter for this front-running or selling their flow. So there's just a lot of money being made by the industry by taking advantage of the participants. And that never ends well. It ends well for those skimming the money off. It's terrible for those that think they're doing something constructive with their time and resources, and typically ends in a complete wipeout. The statistics are that within a year, nearly everyone who tries to do this trading ends up completely bust. So the odds are horrendously stacked against the person trying to do that. So these are the elements that have really been driving the financial markets. And even the International Monetary Fund commented yesterday when they came out with their June 2020 outlook for the rest of the year and beyond. They noted how there's this big disconnect between the worst financial data and economic data since the 1930s and this jubilant returns or jubilant bounce in corporate securities over the last 3 months. And they said that typically that disconnect ends up resolving itself in prices coming down significantly. So that is where we're at. Jeremy Grantham, who of course he's been in the industry over 50 years, and he runs GMO, one of the founders. I've been aware of him for more than 20 years. I remember in the tech wreck how he left stocks early and was punished by customers, firing them. He lost half of the assets under management by people mad that he had left stocks. And, of course, those were the same ones that were day trading as a day job on the side back in the tech wreck euphoria. And, of course, after it crashed, then they realized that they were correct, that GMO was correct to have their discipline and avoid the speculative mania. Then, of course, they got a lot more assets under management after the crash when everyone else was losing. So this is the typical flow. Those who are always long look genius in the up, and then they lose a ton of the client assets in the down cycle, both through capital losses and then for being fired and the clients moving up the street to somebody else. So that's the typical cycle that goes on. And he was saying in an interview just recently, which I posted on the blog, that, this final leg, this final mania around day trading was the piece that he thought was missing. And even though valuations have been obscene for the past couple of years, even though, the Russell 2000 turned down in 2018, that's the small cap companies, has not participated. It's been in a bear market since 2018. And it's really been the S&P 500, the U.S. stock market in particular, that was really bought by, companies buying their own shares. And although it had a big downturn in the last quarter of 2018, it bounced, and then it's made a lower low since in the sell-off into March. So that's really set up a very bearish pattern in the sense that I put a chart of my partner Corey Venable's work on the S&P on my blog this morning, and it basically shows that when you have the lower low, we've now etched out what we considered a neckline, and that neckline in a technical formation is something to be retested in a head and shoulders pattern. And when it's retested in the S&P, that would be something like 2,200 from the current 3,000. So about 27% to the downside would be a retest of that neckline. If it fails there, Jim, then you're likely to see a much lower low. Potentially the next test could be in the 1,500 range, which would be about half of where it is today. So you can see that we've really set this thing up for, as Jeremy Grantham calls it, this is the real McCoy of asset bubbles, and one of the most significant ones of the last 100 years. And so that's where we are. And what we choose to do in response to these conditions will dictate how our financial, wherewithal will be going forward from here.
And what should the reaction be?
Well, you have to be practical and look at the odds. So that, if you want to be a gambler, I always say to people, if you want to participate in a mania, if you think that you want, if you can't do your normal casino stuff because of the COVID shutdown and you're just itching to gamble, then take some money that you can afford to lose, put it in a separate account, and, do whatever you like as a hobby. But when you're talking about the bulk of your net worth, you really cannot afford to ride these manic cycles and to risk the losses that flow on the other side of this. And the proof is in the pudding, because even with all this mania, all this craziness, all these record valuations and capital flowing in indiscriminately, and central banks throwing money and debt that's been added, a decade of that to keep that expansion, so-called expansion, going, we have the largest capital deficits that we've ever had today. Pensions are lacking huge chunks of the funding that they require to pay out the promises. The amount of people that have enough money to retire on has actually shrunk. People couldn't afford to even miss one month of income, both in the household and corporate sector, when the COVID shutdown hit, because they were so thinly capitalized. So it just goes to show you that it's a game that some people are playing. It's not a game that a wise person should play with much of their net worth, because you simply can't afford the stakes.
We'll have more with Danielle Park right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration, with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Danielle Park. Danielle, Canada has lost its AAA credit rating set by Fitch, I believe. What does that mean, and should we be worried about it?
Well, it's certainly we had a AAA rating, which is, if you remember, Jim, coming out of the last recession in 2008, we looked like the golden child, so to speak, because we, went into the downturn with less leverage in the banking system, with less overvalued housing, with less debt in the household sector. We had more resilience and stored capital, so that when the downturn hit, we were hurt less in general in the economy. Our stock market, if you recall, still lost 50%. Our commodity sector was wiped out, 70 to 80% for many of the miners and the oil producers and all that, which is a large chunk of our capital structure. But in reality, the households and businesses were less levered and bounced back quicker. They also were the recipient of the optimism when QE started, the belief that central banks could reinflate the big global asset bubble that had burst because they could pump money into the system. And so we saw that optimism expressed in the form of inflows into commodities again pretty rapidly after the 2008-9 collapse. So Canada was a benefactor of that, and we saw that, our data sort of rallied off the bottom in a reasonable way. Now, what happened is that, of course, that stagnated in about 2011-12, and global growth really hit a peak of what it could organically achieve. And then what we did since then, Jim, was we added debt every single year at every single level. So at the household, the corporation, the government, municipal, provincial, federal, to try and keep the appearance of prosperity, improvements, and growth going forward. We doubled down on the housing sector, which is ultimately a very non-productive way to generate GDP because it's so highly levered. So much debt goes into it, and it distorts or distracts cash flow needed for other pursuits like investment in legitimate business opportunities or innovation, savings for the future. All that is really thwarted when you start pumping the bulk of your investment efforts or cash flows into housing. So that's what we did. And so now we have, coming into, of course, the pandemic, we were the least prepared of many of the countries in the world, certainly of the developed economies. We were very poorly set up. And so when you have a big disruption of income, it hits very hard when people have little savings, a high spending, fixed costs, and, a lot of debt. So that's what happened. And now we've had to quickly, pump money into the households to try and keep people afloat, tried to offer bailouts or credit lines to some of the larger companies, although not a lot of that's been taken up. The plans to add more debt are being less successful here because the fact is that companies want customers here. Companies already have a lot of debt. They don't want more debt. They want customers, or they want less costs. So they're cutting overhead and looking at ways to improve efficiency and reduce their expenditures. So all that is happening, which is the right rational response to this environment, but it's bad for our economic output, for our sales and cash flow. And a lot of the people that have been furloughed are now likely to be permanently laid off. Up to 20% potentially of the people that have been laid off will not be going back to work if you look at various different studies because of this interest in cutting costs given the lower revenue environment. And so what that means is the government's been the benefactor of last resort of necessity, and they've had to they're going to have to borrow a lot of money to fund this support system, which is essential now. They're looking at running a $250 billion deficit potentially in 2020. I mean, the mind boggles at the numbers here. And what it really means is that the future generations of Canadians are going to be paying this money back over the next many decades. And we're going to all pay in the form of higher tax rates. I think that's for sure. So whether that's corporate or capital gains or consumption or property taxes, it's all going to have to go up because there is a limit, and this is what the Fitch report really points out, is that it's nice that we've, that the government has, the federal government has assured the provinces, municipals, households, businesses, everyone that they've got their back, and they've been trying to be very supportive in this time of crisis, but there is a price to be paid for that. And the price to be paid will be future ability to spend and invest cash flow, and indeed at some point our credit rating, because we are just adding that much more debt. Now, I would add that we're not the only country doing this, of course. most countries around the world have runaway debt problems, and the pandemic is certainly compounding that. It's making, I say the plague of the pandemic is both a health crisis as well as a financial crisis, as well as a plastic crisis, frankly. That's a whole other story, and the amount of environmental harm that's happening from this disaster. But anyway, so, that's where we're at, and we have to figure out how we're going to get more efficient, how we're going to increase cash flow where possible, and how we're going to be able to service and finance this debt. One of the ideas, of course, is to issue, 100-year bonds, and that's all fine and well. The problem is that the consumers of those bonds tend to be things like pension plans and institutions that need fixed cash flows. And when you're, locking that in for many years at rates that are 1% and less, that has a cost too, in the form of the ability of these institutions and funds to pay out promises. And it's really, at some point we've seen this in the European Union when rates are so low for so long as they are right now, and as we're presently locking in some of these issues, it really has a very negative effect on the ability of people to consume and pay things, and it actually depletes economic growth going forward as cash flows are diminished.
We'll have more with Danielle Park right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, is it hard for a person to find somebody who's truly a financial advisor and not just a financial product salesman?
Yeah, it really is. And it's not getting better. I saw a survey of so I'm a chartered financial analyst, and we have an, CFA Institute where we take a ethics, oath and commitment, to have fiduciary duty and this sort of thing, just like a lawyer or a doctor does. But ultimately, many of the CFAs work for still, big investment banks where the product is, again, the customer, the client buying the product. They work to underwrite issues for the corporations to sell their stocks and bonds and preferred shares to help them get financing in cash. And the way that they underwrite that is to get their retail crowd to take that product into their accounts in exchange for cash. So the whole bias of the industry is to get people to give them cash in exchange for these corporate securities and issues, and that's where the fees are, right? So ultimately, when a person approaches most of the people that are out there supposedly giving financial advice, in fact, what they're dealing with is someone who's compensated to take their cash in and sell them these equity products or corporate debt products, but very few have any incentive to give them, for example, government bonds. There's no fees basically in putting them into GICs and that sort of thing. So even if that's the safest, most prudent place for savings to be, that's rarely the insight or suggestion they're going to be given. And that's been played out. I remember in the late 1990s, and I was writing about this on the blog as well, many teachers in Canada were given the 85 early retirement factor, and they were given the option, which was, in my view, not constructive or helpful, but they were given the option of cashing a lump sum out of their pension plan rather than staying in the plan and collecting the guaranteed income, which was indexed and had a survivor benefit and all that good stuff for the rest of their lives. So a lot of them, they go to see a financial advisor and they say, hey, I can either take out this $400,000 or $500,000 lump sum, or I can leave it in there and, just collect this $60K a year sort of thing. Well, of course, people that don't know enough about money and have always just made a salary, to them, $400 or $500, that sounds like a massive amount of capital. But when you look at the present value of the income that they would receive from the pension, it would be worth millions of dollars. So they weren't being offered to be given a lump sum of a couple of $1 million. They were being offered to give a commuted lump sum of much, much less. And unfortunately, most of the people that they met with were in the business of gathering assets and directing it into these products in the equity and corporate debt market, which had a much higher risk profile, had nothing guaranteed about them. And indeed, they were doing it at a cycle peak, when then those same assets went on to drop 50 to 70% in value and take a decade to try and recover. So by then, most of the people, they're trying to withdraw income through this whole cycle, and they just end up cannibalizing the savings that they took out. It's a terribly stressful experience, and most end up having to go back to work or figure out ways to downsize because they can't support their lifestyle anymore. So that's really what we've seen in the 2000 cycle. We saw that there was a great many other people, like police officers, that were given cash, commuted some lump sum benefit cash out options in the 2007-8 cycle, near the peak of that. And of course, many of them who took that were decimated the same way. And in the recent cycle, there's been other, sort of working people who have paid into these plans for their whole lives, have been given these lump sum package offers again. And one of the examples was just in the UK, the steel workers. Thousands of them were given these packages where they just say, hey, you have this option of taking this lump sum, or you could just collect this income for the rest of your life. And again, the exact same thing happened, where the person really didn't have any context or understanding of the present value of an income flow, and they took this advice from this product sales cohort who got them into all these products, which then crashed in price and, really high fees, and it's just been a disaster. So now they've started a class action lawsuit again to try and recoup some of their lost money. But as we've seen with these things over the years, the class action lawsuits, you end up, recouping maybe after several years, pennies on the dollar. And ultimately, the organizations who took the money and sold them the products say, hey, we were just giving you, sort of generic advice. We didn't guarantee anything. And so no one's left holding any responsibility, and the people are left holding the losses. So it's the kind of thing that I try and write about and talk about a lot, because it can make all the difference in the world to a person, whether they get, unbiased, honest advice about what's in their best interest, or they get a sales pitch. And so I'm always telling people, if you want to, write me through the blog, and I will give you, any sort of general direction I can on some of the sales pitches they're given. But generally speaking, getting the information correct before is much more advantageous than, trying to go after losses after.
Danielle, thank you so much for being on the show.
Thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite, her website, jugglingdynamite.com. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.